I'm David Blitzer. I work for S&P Dow Jones Indices. You probably heard of us with the ASX 200 and hopefully with the S&P 500. We have a series of committees that oversee our indices, make sure they follow their rules, and I chair a number of those committees, including a couple big ones in New York, and for a long time I did chair the one down here in Sydney for the S&P ASX 200. What's probably my best investment, first of all, wasn't in stocks and wasn't indices at all. But back in 1974, when New York City had a financial crisis and everybody thought the city was going to go bust, my wife and I bought our first apartment. And most everybody who heard us do that or knew we were doing it thought we were lunatics for doing it. But we made out very nicely about 11 years later when we sold it and rolled all the money into a bigger one so we'd have room for our kids. So that was, by sheer luck, maybe a great investment.
I'm Joe Dixon from ASX, and today we're talking about the power of the index. And joining us today is Dr. David Blitzer, Chairman and Managing Director of the Index Committee at S&P Dow Jones Indices. And David's going to explain to us what an index is, how they're created, how companies get into the index, and what it means if they get removed from the index. Thanks for joining us, David.
My pleasure. Good to be here.
Let's start at the beginning. What is an index and what's its purpose?
An index is a list of stocks. You need a rule for what's in and what's not in. And you also need a rule about how they're weighted. Are they all weighted the same by size or by something else? And with that, you can tell what's going on in the stock market. And probably the original use, and I think still a very big use, is an index tells you what's happening in the market. The ASX 200 tells you, did it go up? Did it go down yesterday? Did it go way up? Did it bounce around? It tells you what happened. But increasingly, probably in the last 30 to 40 years, there's been a whole nother use for an index, which has grown and is now very important. And that is, you can build a financial product, an exchange-traded fund that you and I and anybody else can invest in that tracks the index. And it turns out to be a very effective and efficient way to have a way to invest in a whole market or a particular part of a market, do very well, when it happens, very low expenses on top of that.
It sounds like there's a fair bit of history in indices. Let's pause for a minute, take a step way back. The company you work for has been involved in index for a long time. Can you tell us a little bit about the origins of the share market index, please?
Okay. The first one, it's certainly the first one that's still around, was in the United States, and that's the Dow Jones Industrial Average.
Yeah, I think most people have heard of the Dow Jones. Yeah,
absolutely.
Okay.
We hope so.
Yeah.
Part of our name nowadays. Yeah. The Dow started back in 1896, and the beginnings of the Wall Street Journal newspaper, they wanted a way in one number to tell people, did the stock market go up or down?
So this would help them sell newspapers, possibly?
It definitely helped them sell newspapers. In fact, the S&P 500, or really its predecessors, were created for the same reason. It was, in those days, Standard & Poor's sold a whole lot of information about the stock market, and to sell more, they invented an index now called the S&P 500. Mm-hmm. And if you go through a lot of places around the world, the story is the same. Mm-hmm. Financial Times, the FT 100, started with that newspaper. And a lot of newspapers over time gave up their indices because it was easier and they got more bang by using somebody else's index, like the S&P 500, or I would guess here in Australia, like the S&P ASX 200.
Well, let's talk about,
well known.
Yeah, let's talk about Australia. S&P Dow Jones look after the index calculation. Just quickly give us a summary of the main market indices for Australia, please, David.
The number one item, the one that's most widely quoted, is the S&P ASX 200. It's 200 large liquid stocks. It really gives you the center core of the market. But for an investor looking at that, some investors may want fewer than 200 stocks. They don't want just the large ones, but the very large ones. Others may want small stocks. Others may want only real estate stocks and so on. So we sort of slice it up and dice it up in 6 different ways. There is an S&P ASX 20, 50, and 100. And the 20 is the 20 largest stocks. 50 is the next 50, including the 20, and so on. 200 is really the key item. When you get to 300 stocks, it's a very broad range of the market, and that's sort of a description of the overall market. Although there is, to use an older traditional name, the All Ords, which is, I think, 500 stocks, just about anything that's out there.
Yeah, the
is
All
gonna-
Ordinaries Index, that's right.
Right.
Yeah, okay.
So depending on what pieces of the market you want to look at, and in fact, people will do things like take the 300, but then eliminate the 100 biggest stocks and get the next 200, which is sort of the middle section. We'll also split it up by industry. Natural resources is a major factor in Australia. Real estate is another major factor. Or divisions which we use around the world, things like financials or healthcare, that, industries that repeat from country to country.
From what I understand, indices are extremely powerful for companies. And so once a company's listed on ASX or on any exchange around the world, their inclusion in a particular index can have a big bearing on their how much research gets conducted on them, how much interest is there from different investors. S&P Dow Jones Index and the Index Committee must have a lot of power in determining which companies go in which index. Take some time. Can you explain to me what your decision process or the rules-based framework that you use to include companies into an index?
The indices here are very much rules-based, and we look at the stocks by ranking them by size. Size in this case means what we call forward-adjusted market cap.
Forward-adjusted market cap.
Yes.
All right.
When you look at an index, you want to look at not just the value of the shares on the market and how many shares there are on the market, but you want to look at the ones that are really on the market. So if you've got a company where the founder or the family of the founder, if he was founded 3 generations ago, let's say owns 20% of the stock, and they're not going to sell it. It's their heritage almost. That's not on the market. They're going to hang on to their 20% through thick and thin. So we're going to look at the other 80% that is on the market. And when we say forward adjusted, we don't count the 20% that's held by the family. If in some countries, the government will own a huge block of the stock. The government not going to trade it because the stock went up or down. They're the government, so we're not going to count that holding it the same way. So we look at the float adjusted market cap, which is a much better measure of what that company means to the market. And as an aside, if you had a company where 90% is held either by the government or the founding family or 3 people on the board of directors and so on, that stock's really not very big impact on the market, even though it may sound big. So that gets shrunken down. So first we look at size. And second of all, we look at what we call liquidity. How much it trades and how much trading activity there is. We don't want a stock where somebody comes in and buys 1,000 shares, the thing suddenly pops up because there's not much that's tradable. We want a stock that's quite liquid, so that if somebody buys 10,000 shares, it barely wiggles and that kind of thing. Because one investor shouldn't be able to create turmoil in the market and so on. We rank them on size and liquidity, and we start at the top, and the first 20 are the ASX 20, 50 from number 1 to 50, and so on. So the ASX 200 is going to be the 200 stocks. Now, number 200, because markets fluctuate, it may be number 199 one day, and 3 days later, maybe number 202, and then 195, and then 210. You don't want to keep throwing them out and putting them back in because they bounce around a little bit. So we have what's called a buffer, which means we leave a little wiggle room above and below the 200 mark so that we don't have to keep throwing people out or putting them in and creating turmoil when they shouldn't be there.
That's a really important part I want to talk about next, is that the companies that are down the bottom of the list, on whatever size index, and I hear about quarterly rebalancing, and rebalancing being something that can have quite an impact on a company. If a company gets rebalanced or removed from an index, why would it be removed? And just can you give us some insight on what the repercussions might be for it?
Well, I guess one way I sometimes think about being on an index or being off an index for a company, and at least with the S&P 500, where the rules are somewhat different, it probably has bigger impact, is what I call the list effect. If you're on the list, certain things happen. If you're not on the list, they don't happen. One of the ironies is being on the list, you get a lot of attention. You'll probably get more securities analysts paying attention to you. You may get more calls from reporters at financial papers and so on. And your name probably pops up on lists of potential acquisitions by bigger companies. That's sometimes the list is not always the best thing, but everybody seems to want it anyhow. If a company gets added, not overnight, but gradually over a period of time, it will get noticed and so on. If a company gets dropped off, immediately people are going to wonder why. What happened? Did they do something wrong? When we do a rebalance, which every quarter the index committee sits down and they go through all the indices, top to bottom, they redo the ranking, check the data and so on. When we announce that, we always say that an index change or an adjustment is not an investment opinion because we're just following the rules. We're not picking hot stocks. In fact, I've been doing this for a long time. You don't want me picking hot stocks, I can assure you of that. So we go to great lengths to say to investors and analysts and so on, look at the numbers, look at what happened, see if you think our data is right and so on. But we're not telling you this stock is a bad investment because its number dropped from 200 to 215. We're not telling you some other one's a great investment because the number went from 215 to 195. We're telling you that's where the numbers were. And it may be some stock up at number 100 that got very big or very small that sort of pushed the list around.
That's probably a good point, is you're not making a judgment call on the investment viability of a company, are you, when it's rebalanced?
Definitely not.
Okay.
We're sticking to our rules and so on. Now, clearly there are unusual cases where we're going to do something right away. The obvious ones, if a company gets taken over in an acquisition or is in a merger, or if unfortunately they file for bankruptcy or something, we'll have to adjust the index when that happens. And if they're delisted from the exchange, they're going out because nobody can buy them, so it's pointless to have them on the list at that point. But otherwise, virtually all the normal changes will get done out of each quarterly rebalance.
So the S&P ASX 200 index will give us an indication as to the performance of the largest 200 companies on the market. But if investors aren't interested in the whole market and they just want to look at banks or resources, do indices give us the ability to cut up and look at those sectors individually?
They do. First of all, the whole market is made up of the separate companies in a whole bunch of different industries. And for any company in the index, we know more than just how big it is in terms of market value. We also know what it does, what kind of business it's in. So we can take, let's say, all the banks, and we'll make them another index, or we might call it a sub-index. That's just the banks. We can take real estate investment trusts, A-REITs, and make another index of those, and so on. And you can go through the whole 200 stocks, creating a bunch of indices, and then you'll get ideas. Banks didn't do as well as real estate. Natural resources did much better last year than they do this year. All that kinds of things. We can also slice it up in a different way, and that is some investors like to talk about growth companies. Sounds like you ought to be there. Other investors might talk about value companies, which usually means the stock is going down and you hope there's a lot of value in it. So we can cut the market up into growth companies and value companies, and an investor will say, well, this is a growth market because the growth companies, according to the split, are doing better. So by slicing and dicing the index, we can tell you all kinds of analyses or all kinds of stories about what's happening in the stock market, and maybe to give you a better idea whether you should be in the market or out of the market. But you got to remember, there are no guarantees in this business. Forecasting about the future really is very difficult.
I mean, for people who love to learn about the index and want to learn a little bit more, where would be the best place for them to go be?
I think the place to start, we run a website with a whole lot of information it's on. I'm sure the exchange runs one as well. But among the things they'll find there, they'll find a rather thick book, if they have insomnia, maybe a good cure, called The Methodologies for the S&P ASX Indices, which will go through all the rules, list the indices, tell you what's in them, tell you how they work and that kind of thing.
So it's transparent, the information's there if people want to find it.
It is completely there and so on, and you should be able to, or an investor should be able to go through that, and if they have access to the kind of data sources that we do or the exchange does and so on, they should be able to do the same kind of analysis that we're doing.
Thanks for joining us, David. Appreciate it.
My pleasure. Very good.